everybody, Marco Carbajo here from businesscreditblogger.com. Today's video, we are going to talk about how to get business lines of credit for your startup at 0% interest for 6 to 15 months. So if you're just launching your business, you're forming your company, or you've been in business for maybe a couple months and you're just getting started, you need cash credit, this is the video for you. So let's get started. Okay, so there's challenges. I want to first congratulate you for starting your own business, and you're at a position right now where, let's say you have an idea, you need to buy some inventory, or you're looking to create an online business, you need to scale it, you need to market it, you need access to money so you can start doing some things for your business to generate revenue, generate a profit. So you're looking for some cash credit. Okay, so what's the challenges for you in approaching different banks and lenders to get actual funding for your startup? Well, they look at startups, just the reality is startups under 2 years of business is one of the highest risks. Okay, so that's the challenge for you because you have a lack of business history. You don't have any type of track record for a lender or anything to look at. And the second challenge for you is you don't have any revenues coming into your company right now. You may have a job, you may be doing a side hustle and starting a side business. So you have personal income, or you have other forms of income that are not from your business, but your business itself can't really stand on its own yet. It's a startup. So you need access to funding to get revenues generated for your company. Okay, so another startup for you is you have a lack of established business credit. What does that mean? That means no one has actually lent money to you, no banks or anything like that, so your business can't show a track record of financial history. Now, you see me do videos before of ways for you to establish business credit with like net 30 vendors, so you might want to watch this video right here. So that's ways for you to get credit from retailers or suppliers or vendors that will extend credit to your startup. But that limits you because you can only use those short-term credit, those net 30 accounts with that particular company. You only can buy their products and services. But you may be in a position right now where you actually need cash. Building business credit with vendors is a great strategy. That'll get you to start building up your business credit file. But I'm going to talk to you in this video about how to actually get cash credit as a startup. And let's say another challenge is you don't have any collateral you can put up. Okay, so some banks will give you a line of credit, but if you secure that line of credit, they may require some real estate as collateral or other types of collateral to secure to get your line of credit for your startup. But let's say you have no collateral, and let's say you lack any other type of financials that they want to see, like retirement assets, etc. So I'm just going over some of the most important challenges that most startups face when they're getting started. And you have a lack of funding, so that's why you need cash credit. You want credit that's available to you when you need it. You may not want a loan right now because you have those fixed terms, fixed monthly payments, and you may not be able to put that cash to work. But let's say you need credit for your business. You need it when something comes up. You may need to buy some equipment. You need to hire some more employees. You may need to start a marketing campaign. So you want something that's flexible. It's there when you need it. I call it cash on demand. Now, what you want that flexibility too. Flexibility means if you do borrow on your credit line for your business, you have flexibility on how you want to repay on that money that you borrowed. Okay, so with revolving business lines of credit, you have either a minimum payment, which is about 1% of how much you borrowed that you pay monthly. That's one option. The flexibility also is you could pay more than the minimum payment. And the third option, you can just pay it in full if you want and not have to worry about interest. So that's the type of flexibility I'm talking about in this types of lines of credit. And you want something that's very fast. So you can get that credit with a credit card for the business. You can just swipe it, buy what you need for the business. That's fast. If you need cash, you could just withdraw it, go to ATM, or you could pull cash out from your card. That's fast as well. So now, let's just say, for example, in this video, you have all these things. You have a lack of business history, lack of revenue. You don't have the collateral or anything like that. So I want to share with you why cash credit is so powerful is because this particular video will show you how you can get up to $100,000 in revolving business lines of credit anywhere from 15 to 25 days. So you're probably wondering, well, how am I going to be able to get unsecured revolving lines of credit if I have no history, no established business credit, no financials, no revenues for the business, no collateral? How can I do that? okay, being that you're a startup business. All right, so we're going to get into that, and we're going to share with you how you can get this revolving lines of credit at 0% intro APR for 6 to 15 months. So that's interest-free money, interest-free cash credit that's available to you. So let's say if you buy inventory and you could turn over that inventory in, let's say you have 0% for 15 months on a couple of your business credit cards. Guess what? You're borrowing that money interest-free, launch your business, sell your products, get your money back, turn a profit, pay back what you borrowed at 0% interest. So it literally didn't cost you any money. So that's what's powerful about this cash credit strategy I'm going to share with you. Now, these particular business credit cards are revolving lines of credit. They don't report to your personal credit. So as a business owner, we talk about building business credit, protecting your personal credit. These particular credit cards for the business only show up on your business credit reports, not your personal credit reports. So this will help you protect your personal credit. So if you have debt on your business credit cards for your company, it will not impact your personal credit utilization. It will not impact your personal credit scores. Okay, so that's powerful. So this is unsecured money. There's no collateral you have to put up for these revolving lines of business credit. There's no financials you have to provide. And remember, this is for startups. So there's no tax returns you're going to be asked to provide. There's no income verification. This is a stated income program. We like to call it a no-doc program. It's the easiest form of credit to raise for a startup. Okay, so if you have all these things, you can get all these revolving lines of business credit at 0% for 6 to 15 months, but you don't have to do financials, no tax returns, no income verification, no time and business requirement. Then what actually are the banks looking at? What are they looking at to be able to extend these types of lines of credit to you as a startup? Because the money is readily available. It's all about leverage. So remember, if your business doesn't have a track record, if your business doesn't have financials, doesn't have tax returns, doesn't have revenues, then what they're going to look at is you, the owner. Okay, so you're going to have good, strong personal credit, and you're going to co-sign for your business. Okay, so it's all about leveraging the strength of your personal credit. So that's the only thing you need to bring to the table for this particular type of funding. Is you're going to basically co-sign for your business. We call that a personal credit check. We call that a PG. You're basically co-signing for your business. Most people say, well, you know what? I don't want to really co-sign for my business. I want my business to stand on its own. If you need cash credit and your business doesn't have any track record, doesn't have any financials, no revenues, then the only way for you to raise capital is you as an owner are going to have to pledge and co-sign for your business. Now, the argument with that is I want to share with you is if you worked all your life to build up a strong personal credit, you're responsible, you manage your personal credit cards, you get great, let's say great interest rates with your credit cards, you'd be able to get a mortgage, you'd be able to get a car loan, and you built a strong personal credit history and you're proud of that. Why not leverage that to your advantage? You have a startup over here that doesn't have any of that track record yet. No history, nothing like that, but you've already established this asset over here, which is your personal credit. So to help your startup leverage and get credit from the banks, you're going to need to co-sign for your business if you want to get access to cash credit right away. Okay? So of course, there's other strategies. You can bootstrap, you can borrow from friends and family, you could try to bring on investors, etc. There's lots of different strategies like that. This is just one strategy where you're basically leverage the strength of your good personal credit. Okay, so when you use the strength of your personal credit to co-sign for your business, this is going to allow your new startup to acquire multiple lines of business credit. It allows your business to start up with anywhere from $25,000 up to $100,000 in credit, cash credit that you can use to grow your startup. Now remember, you may think, well, you know, if I co-sign for a business, then there's a risk. Of course, when you start your own business, starting your own business is a risk. Okay, that's a risk you're going to undertake. And if you're willing to co-sign for your business as a guarantor, there's a risk involved. Okay, but remember, if you're going to want to get that jump start and get access to cash credit right away as a startup, then co-signing is a great thing to get your business set up with multiple banks, multiple relationships, building business credit that much faster. Because remember, if you're getting multiple lines of credit for the business, which you co-sign for your company, now that your business is going to have established 4 to 5 banking relationships. So in the future, let's say 6-12 months down the line, when your business needs to get more credit, it can now apply for credit with those particular banks that for additional funding products or additional cards, which it now has a relationship with. Okay, so that's some long-term strategies to think about. Okay, also this will help your company build its own credit worthiness, because these particular accounts that we get set up for your business report to the business credit reporting agencies only, not personal credit. This will protect your personal credit. The only thing that's going to impact your personal credit by co-signing for business is that, yes, you will get a hard inquiry from each of the banks. Typically, we apply about 4 to 5 different banks on behalf of the business. So that's what you're looking at. And that doesn't mean you're going to get 4 to 5 inquiries per bureau. Typically, the bank card issuers on the bank list may pull from 1 bureau for qualification, or they may pull from 1 or 2. So you may end up with a couple inquiries. But when you're done with this funding round, you want to wait at least 90 days to 120 days before you apply for additional credit. So this will help position your brand new startup to scale much faster, because you're basically getting 4 to 5 revolving lines of business credit that allow you to buy products and services your company needs. Okay, so let's talk about the 3 main factors. This is really, really important on what's going to determine on how much in credit lines you can get for your brand new startup. So the first thing we're going to look at is your entity. You want to look at primary ownership matters. What does that exactly mean? That means that it's much better for you as an owner to be on the original documents, the formation documents of your company. So the easier it is to connect the dots between you as the owner and the business, the easier it is for funding. That's just from a funding perspective only. Of course, there's many, we've seen plenty of videos where they talk about, incorporating in like in Nevada or Delaware and hide yourself, etc. And there's needs for that. I understand that. But when it comes to funding, banks want to be able to connect the dots. If you're co-signing for the business, you're the guarantor for the company, and they have to be able to see on whether incorporation documents, they look at the state filing records, it has to show you on there as ownership of the business, okay? So primary ownership does matter. That's very important. The second thing, that's main criteria, is your credit scores. We're going to break that down in a second. That's going to determine how much credit and capital you're going to raise for unsecured business lines of credit. The third is the actual credit report itself. Now, let's break down each of these 3 main factors. So let's talk about credit scores. There's a minimum credit score requirement you're going to have, which is 680 or higher on 2 or more of your files. So if you have a 680, 690, and then let's say a 650 on the third one, that's okay. You want to have at least 2 of them with 680 or higher. That doesn't mean you're going to get qualified for revolving lines of business credit. That's a benchmark indicator, and that's a minimum requirement. Okay, if you have less than that, that's okay. I would recommend to do the pre-qual review anyway, because we can give you some other recommendations, like a prepaid business credit card option or a secured business credit card option. We will give you some recommendations if you don't meet these score requirements for your startup. There's also different tiers, and there's risk factors in credit scores. So credit scores are benchmark indicators for lenders and banks and card issuers. But that's not the only thing to look at, especially with business credit cards. Many business credit card issuers, they do manual reviews. They look at the actual credit report itself. So don't think because you have a 750 credit score that you're going to get 100,000 revolving lines of business credit. I'm going to break that down to you on the actual credit reports. And you can look at your credit report and look at what we go over in this video, so it'll help you kind of see where you're at. But this is the first level of qualification, is credit score. So 680 or higher with 2 or more bureaus is the minimum requirement, okay? Now, you may have a utilization issue if your credit score is a little bit below that, or you may have a derogatory. You want to work on getting that improved and get those scores up. You'll see on the bottom of this presentation, this link right here. This is to start the pre-qualification process, but don't go there yet. Let's break this down even more. So we talked about credit scores. Let's talk about comparable credit. Let's talk about the actual credit report itself. This is really big when it comes to revolving business lines of credit, or let's just call them business credit cards, okay? Because that's the easiest form of credit to get as a startup, and that's what we're talking about in this video. So when you're doing a pre-qual review, when you're applying for a business credit card for your company, banks look at your comparable credit. Because remember, your business has no track record. So if you're trying to apply for a business credit card, they look at your comparable credit. As an owner, how much personal credit card have you managed? What's the size of your credit limit? So they're going to look at the comparable credit. Okay, so let's talk about your primary credit cards when we just talked about comparable credit. They are going to look at your active credit cards, not ones that you've closed, but you look at your primary credit cards that you have on your credit report right now. Now, many times you may have a high score and we see credit reports that have authorized user accounts. Those don't count. Those help boost up your score, but when it comes to the actual credit report, the underwriters look at your primary credit cards, the cards that you have in your personal name. Okay, or you can have a joint credit card. That's different than an authorized user card. Okay, but primaries are number one. So they're going to look at your primary credit cards. They're going to look at how many of them you have, who issued those particular credit cards. Mainstream bank card issuers are a plus. So like your B of A's, American Express, Discover, Chase, etc. on your personal credit cards. They also go look at the size of your credit limits. That's going to be a huge factor in how much business credit card limits you're going to get on the business side for your startup. Okay, so if the highest credit limit you have on a personal credit card is $5,000, okay, then don't expect to get a $20,000 business credit card for your brand new startup. They're going to be comparable limits when a bank issues you that limit. So it may be a $5,000 or $7,500 credit limit on that one particular bank because it's comparable. Okay, so the higher the credit limits that you have for your business, on your personal credit reports, the better it is for the business. Okay, so that doesn't mean that's the only factor, but it's a big factor. They look at the age of your accounts. How long have you had your credit cards? How long have you managed them? They're going to look at your payment history. Have you been late paid on any of these credit cards? So that this is all about your comparable credit, and they're going to look at your credit utilization. How are you managing credit utilization on your individual cards as well as overall? It's very, very important on your personal credit cards to have a couple of cards at zero balances when you're applying for credit card funding for the business. Okay, because you don't want to have balances on all of your credit cards. Some zero balances is very powerful, but if you're not sure, don't worry. When you do the review with us, if you need to make some pay downs or you need to move some money around, we'll let you know if your profile is not optimum where it needs to be for funding. Okay, so this is called comparable credit, and your credit card history on the personal side is going to be very, very important as far as the credit cards you manage. The next thing that's looked at is the types of accounts that you have. So we talked about primary credit cards. Do you have any installment loans on your personal credit? Do you have any auto loans or leases on your credit? This is all about your personal right now, because so when we're doing a review, the main thing is your primary credit cards. That's what we're looking at. Then you look at all the other types of accounts that you have. It helps if you have a mortgage on your credit report. The third thing is your inquiries, recent activity. You don't want to have more than 3 inquiries within a 90-day period. Okay, now the types of inquiries are very important. Okay, so you don't want to have 3 inquiries that are credit card related. If let's say you have a mortgage inquiry that was done 60 days ago, you have 1 credit card inquiry, and then you have 1 auto loan inquiry you did 90 days ago, that's okay. Okay, but if we see 3 credit card inquiries in the past 30 days, then most likely, we're not going to be providing you a funding projection. There's just too much activity. It shows that you're aggressively applying for credit cards, etc. So the number of inquiries play a big factor. But let's say you had 3 inquiries 6 months ago. That's fine. We're talking about recent activity. So typically you want to limit any inquiries in the past 90 days. But if you have 1 or 2, that's fine. Okay, so number of inquiries is a key factor. The age of the inquiries also plays a big factor as well. The older the inquiries that you have, the better. And then there's the types of inquiries, which I just talked about. The other thing that we look at is your new accounts. If you just opened up, again, comparable credit, if you just opened up 3 new credit cards in the past 90 days, that's a lot of recent activity. So typically we might tell you to wait 6 months to come back. So new accounts is a factor. If you had, let's say, a mortgage done 90 days ago and an auto loan, that's typically okay because it's not comparable. All right. Now we also look at derogatory items as something that you want to be obviously very aware of. Late payments that you have, work to get those removed. Any unpaid collections need to be paid. Charge-offs have obviously a negative impact, and also it's the age of the derogatories that play a factor. Any unpaid tax liens is a no-no, and in a bankruptcy filing. Now, the key thing with the bankruptcy filing is if it is reporting on your credit report, and let's say it's 5 years old, 6 years old, they stay on there for typically 10. They stay on there for 10 years. What matters is how you reestablish your credit since the bankruptcy filing. Okay, so, but if the bankruptcy is under 5 years, it's typically we're not gonna be able to provide you a funding projection for this particular type of funding as a startup. Okay, so let me just kind of give you an example of an actual client that went through a funding round. We got this particular client $75,000 in revolving business lines of credit on 25-day time period, and these are the 4 accounts they got. Each card came with 0% intro APR on purchases. 2 of the cards had 0% for 6. One was 6 months for purchases and balance transfers. Another one had 0% APR for 12 months for purchases and balance transfers, and the other 2 had a 12-month 0% and 1 9-month on purchases. Okay, so that's cash credit that's available for this individual. Let's break it down. What was the credit report? How did he get this? Okay, 778, 772, and 783, good, decent scores. 8 active accounts, several mortgages. So, but had 1 auto and 3 credit cards. Now, so it's had some activity on the credit report. Had some really good blend of credit, a mortgage, auto, credit cards. Credit utilization was 27% on 1 of the cards. The other 2 cards had a 0 balance. And of those 2 cards at 0 balance, the highest credit limit was $10,000. It was actually a Capital One card. But look at this. That Capital One card he had for 14 years. So there's a super long credit history there. Okay, so that's another big factor. If you only had a credit card, let's say with a decent credit limit, but it's only a year old, that's pretty new. Even, so if you want ideally 5 years or older on the credit cards that you have. All right, those just all play a role. He only had 1 inquiry on his credit report in the past 12 months, and the other 2 inquiries were just about to fall off the credit report, so they're almost 2 years old. So that was very, very nice to show that this individual wasn't looking for credit, wasn't applying aggressively. 0 derogatories, 0 collections, 0 late payments on his credit report. We were to get him $75,000 unsecured business lines of credit. Those 4 credit cards he got in 25 days. So this is just an example of what's available when you have really strong personal credit and you have a startup and you're trying to raise access to credit right away for your business. So if you want to find out how much you pre-qualify for your brand new startup, or even if you're an existing business and you're looking for a no-doc funding, you want business credit cards, revolving lines that report to business only, then this is our step for pre-qualification. You just order your credit report. If you have a credit report already, that's fine. You don't have to order one, but we recommend creditreportengine.com. It's only $1. You download your credit report in PDF format, and then you're going to go to our pre-qual form. So you go to businesscreditbuilders.org/pre-qualification. That'll take you to our pre-qualification form. You just fill out the form. It's really, really simple, and upload your credit report securely there. And it'll take us about 48 hours to do the review, and then we'll contact you back with results, what the projections are. Our funding process takes about 14 to 20 days. If you don't qualify, let's say there's an issue with the credit report or your utilization is too high, we're going to give you some recommendations on what you need to do to qualify. Now, if there's another issue where we can't provide you any recommendations as far as what you could do with your credit report, we're going to also provide you some alternative options of ways for you to get credit and funding for your business. So at the end of the day, we're going to give you some guidance as to what to do to start building up your business credit and getting access to funding for your startup. So with that, if you found this information useful, definitely give us a thumbs up, click subscribe. That way you're notified every single time we come out with a video. If you want to learn more about our other products and services, such as our business credit card funding, our loans, lines of credit, as well as our business credit building system, check out businesscreditbuilders.org. Thank you very much for watching the video. We'll talk to you real soon. Make it a great day.